Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we'll be looking at the stochastic oscillator. The stochastic oscillator was developed by George C. Lane in the late 1950s. This oscillator is a momentum indicator that shows the location of the close of a single period related to the high-low range over a set number of periods. Let me try to simplify that. The way it's set up is on 14 periods. In this particular chart I'm looking at a 3-month chart. Each one of these candlesticks represents a single day, but we'll just refer to them as periods because this can be used on any chart. It could be monthly chart, weekly chart, intraday periods, etc., etc. So these periods, you're going to be looking at 14 candlesticks in this case. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. This is showing you the highest point of this 14 period is here. The lowest point is here. And so in that range, where was the close of the most recent candlestick or the most recent period? It was obviously at the high point. Therefore, the stoch is going to be well above the 80 line, way up here. Okay? The stochastic oscillator isn't really designed to follow price, and it's not designed to follow volume. It's following momentum. As a rule, the momentum would change direction before price does. Lane was looking for situations where he had a divergence, where price was moving one direction and momentum was moving another direction. This told him something was amiss, and he could possibly trade and expect those two to come into line again. We'll show you that in a bit. Because the oscillator is range bound, it will show you overbought and oversold conditions, or it can show you overbought and oversold conditions. When I say that it's range bound, it means that it goes from 0 way down here to 100 way up here, and the stoch will always trade within those points. It will never go beyond those points, no matter how high or how low price actually goes. Typically, in regular markets, anything that's an 80 or above is considered to be overextended or overbought. Anything at the 20 or below is expected or signaling that it's oversold short term. When the stochastic oscillator is trading above the 50 line, dead smack in the center here, it is considered to be bullish because price is traded in the upper half of the range. When it's below 50, it's considered to be bearish because it's in the lower half of the range, and that's how price activity trades. When people are bullish, they drive prices up to the top of the candlesticks, the top of the ranges, like you're seeing back here. When they're very bearish, you'll see it the exact opposite. They'll sell it off to the lows of the day. There are 3 different types of the stochastic oscillator. There's the fast, the slow, and the full. We'll discuss all 3 here, but the first one that was ever introduced was the fast, and this is how he actually set it up. The fast has 2 individual lines. You'll see a black one here and a red one here for this particular chart. The black one is the %K, and the red one is the %D. We'll talk about both of those. The %K is what we already talked about back here. You've got the close relative to the 14-day look-back period. That's the default settings. Looking at the close relative to the highest point of the 14-day period, or the 14 period, and the lowest point. In relation to that is where you're going to find your %K at. You also notice it's very choppy here. We'll get to that in a minute. And the %D is simply takes the %K and then applies a 3-day simple moving average to it to smooth it out. This is actually what Lane was using when he was looking for divergences. He wasn't looking at the %K, he was looking at the %D. And actually, he would consider a buy and sell signal only based on a divergence for price actually diverged from what was going on with the %D, the red line. So that's why the slow stoch was actually invented. Let me show you those two together. The slow stoch, like I said, was brought out or pushed out there to show that the %D of the fast stoch was the most important element for finding divergences here. You'll notice a couple things. The %K here on the fast stoch is much choppier. You've got this move going on here. right? And then the percent K on the slow Stoch is just very smooth, right? There's no more choppiness. What they did was they simply took the percent K of the fast Stoch and applied a 3-day simple moving average to it, or a 3-period simple moving average to it. Well, in effect, all that did was make the percent D the percent K on the slow Stoch. Or you could say the other way, the slow Stoch percent K is actually the same exact line, the same exact points as the percent D on the fast Stoch. The percent D on the slow Stoch, the red line here, they simply added another 3-day simple moving average to that and created a signal line, basically. So this is actually the one I use in my trading model. Whenever I'm looking at a stochastic oscillator, it's going to be the slow Stoch. That's the one I prefer. It's going to smooth out a lot of the choppiness of the fast Stoch, and it's going to give me the line I want to look at. If you see somebody out there looking for divergences and they're using the fast Stoch, but they're looking at divergences on the percent K, they're doing it wrong. It's the percent D of the fast K. On the slow Stoch, then you can be using the percent K. Now let's introduce the full Stoch. As I've already stated, the fast Stoch percent K, the black line here, has no simple moving average applied to it, and therefore it's very choppy. They smoothed it out and applied a simple moving average of 3 to the percent K to A, smooth it out, and to B, create the percent D of the fast Stoch. But you can't adjust it on the slow Stoch. You cannot change it from a 3-period simple moving average to a 5 or to a 7. You can't make any changes to it. The full Stoch will actually allow you to do that. That's why you see here you've got 14 period, 14 period. There's no other thing to change here. Here you've got 14 period, and there's that 3 that you can actually start adjusting. That here is just untouchable on the slow Stoch, and there isn't one on the fast Stoch. You'll also notice that when left in default position, as this is, the full Stoch looks just like the full Stoch will act just like the slow Stoch. So you actually have to go in there and change those details. If you're not changing those details and using the full Stoch, well, then you're really just using the slow Stoch. Regarding altering the settings, like I said, Mr. Lane created with the 14 look back period, and that to me is good enough. I mean, he knew what he was doing. He invented it, and if I can't get a signal, I'll simply find another chart that gives me better signal. So what you need to know about changing these settings here, if you change the 14 look back period to like a 20 or something like that, you'll get fewer signals, which means she won't be as volatile. So you won't see as many times that actually the percent K and percent D will move up above the -80 line. Will be fewer the bigger this number is here. Now if you were to decrease it to say 7, you would see it a lot more radical. So a lot of guys who want to trade more will alter that. For the rest of this video, I will use the slow Stoch in all of the analysis process. Before we look at some chart examples, it's important to note that overbought readings are not necessarily bearish. Securities can become overbought and remain that way during a strong uptrend. Closing levels that are consistently near the top of the range indicate sustained buying pressure. In a similar way of looking at it, oversold readings are not necessarily bullish. It doesn't mean just because you're oversold on the slow Stoch you need to go buy. Securities can remain oversold in a strong downtrend for an extended period of time. Closing levels consistently near the bottom of the range indicate sustained selling pressure. It is therefore important to identify the bigger trend and trade in the direction of this trend. Let me get out the tools here. What a lot of traders will do is they'll look at the overall trend. In this particular case, your trend is up. You got a series of higher low points like this. So what they would do is simply use the slow Stoch or the stochastic oscillator, whichever one they're using, and they would focus on oversold situations. Whenever price fell down below the 20 line, they would look for an opportunity to be a buyer, and they would remember to use the slow Stoch as a timing tool and not as a selection tool. That means you still have to go find a reason to buy, not just because you fall below 20 and we're going to buy. You've got to have a reason. And in this particular case, you had an inverted hammer here telling you look for a move back to the upside. The next day, you've got to move to the upside, higher high, higher low. everything was showing you this is actually turning around. And you'll see that the signal line here and the slow stotch actually broke above the -20 line at that point. So that was confirming that move to the upside there. When they're trading that uptrend, when they've found the opportunity, that there's a timing situation that says, okay, it's now time to go looking for a buy opportunity, they'll take that opportunity, but they will ignore situations that are saying that it's overbought, because in an uptrend you can get overbought and stay that way for an extended period of time, and price will continue to just simply advance. So it's important to know what type of a trend you're in, uptrend or downtrend, or you're moving sideways, or a flat trend. When we find a situation where price activity is moving sideways in a range, you can have a high point, low point, high point, low point, but it's basically not breaking out to either side. It's just remaining within this range. You can use the stochastic oscillator from both sides. So you got the -80 line would be where you'd be doing your selling or your shorting, and the the 80 line, and where you got your 20 line would be where you'd be looking for your buy opportunities, or you're covering the short opportunities. So here you've got sell. Well, you wouldn't be able to use it there, but at this point you'd know you're starting to get range bound, and you would start looking for opportunities where you could be a buyer on the pullbacks and seller on the advances back above the 80 line. You can trade like this, okay? Sorry about that. You have to have a situation where the market or the chart is moving sideways in order for that to work, where you can trade both sides, just using it like an oscillator, calling overbought and oversold situations. Finally, when you're dealing with a downtrend, when you have a series of lower highs and lower lows, you'd be looking for opportunities to sell short whenever you got above the 80 line on the slow stotch or any stochastic oscillator. Like you had back here, you could have used that. And again, just like you would with a bullish perspective, you would invert it, ignoring extreme oversold conditions, because you would not actually, it wouldn't necessarily be true buy opportunity just because they fell below the -20 line in a downtrend. So keep that in mind. This is video 1 of 2 on this particular indicator. The remaining video will cover all the signals that Lane discovered and teaches regarding your divergences, all 4 different divergences. So for that, look at the second video in the series. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.